As always, this live show is for educational purpose only and does not constitute any investment advice. You trade at your own risk and with your own responsibility, and you're the only one responsible for your transaction. So, as always, we're going to do this live in several sections. We're going to start by reviewing the economic news, even though there's not a lot of economic news today. We are going to then look at the economic calendar and the different asset classes. Afterward, we're going to look at the S&P 500 from a technical point to try to establish our trade plan for the day. And then while we're waiting for the market to come to us, we will answer a few questions people ask us, and we're going to try to answer them the best we can. Today is going to be more focused about trading psychology, technical analysis, and risk management. So while we are talking about the economic news, today I didn't find a lot of economic news. Mostly the most important, like the biggest news I found that I thought was relevant was something about mostly Congo, the Congolese election from Congo-Kinshasa, where there's a chaos, and I find it important because Congo-Kinshasa is a worldwide leader in several rare minerals that are needed to build PCBs and therefore phones and high-tech tech items. Otherwise, I saw an analysis, but and I like it, so I'm gonna basically try to show my perspective on it. But mostly it was. I will show it to you. Up, I'm coming. Where is it? Where is it? Where is it? It's here. It was this one, and basically he was counting Elliott wave, and he offered the count of the actual move with like the 5 Elliott waves, and I think it fits. And especially if you look now, I'm gonna show you on my on the 4 hour. Like I already discount. And we can see like the 5 waves, and now we are entering, you know, like the correction wave, which is A, B, and C, and therefore normally the next step should be to go around there. More or less. So that's basically what he was saying in his analysis, and I, to be honest, kind of agree with him. So, yeah, now, so let's see, economic calendar, it's there for the week. Mostly on Mondays there was not many news, mostly some German one and some speech by European Central Bank leaders. Then on Tuesday was another speech, and then the CPI for Europe that came back worse than expected, but better. If we take in consideration the actual situation of Europe with a lot of inflation and inflationary context, so which it means the price decreased more than what was expected for the period. And then afterward we had the building permit and housing start, and we can see that basically there was like an increase in the overall housing market in the US, because there was some new, there was more than more new housing start than expected, and there was that building permit missed. Might be a bit weird to understand the way I said it, but basically we missed the expectation for building permit, or exceeded the expectation by 200. Therefore, if we take the average, where the housing market in the US is in pretty good shape. If we look at Wednesday, we got some CPI in UK, some PPI in Germany, US consumer confidence and home sales. So we see that the market was higher than expected, but there was a huge decrease in the oil demand. For today, mostly there was the jobless claim as well, the continuing jobless claim as well as the initial jobless claim. So we can see there's approximately 2 million unemployed people in the US that are now getting the unemployment benefit. And basically the GDP is worse than expected for the US also, but it's still an increase compared to previously. Oh, I've got 1 FPS, nice. And tomorrow we mostly have PCE and some UK stats and also some home sales and yeah, like every Friday. So if we look at the different asset class, I'm gonna today talk a bit about wheat because I've learned some stuff. So let's start by the bond. We can see not especially the US 10-year fell sharply at the open, because when I looked this morning it was stable at 0%. So basically the open was a big buyback of lot of people bought some 10-year bonds. Same for basically most of the bond is a French one or German one. There's only UK one that are still where the yield are climbing, but we can still see that the yield are way lower than they used to be, especially US one. Like 1 month and a half ago, 10-year was 5. Now it's 3.8, and it's gonna go down following the Fed rate decision. Then if we look at equity, we can see that Europe is mostly in the red. Like is in the red, is slightly in the red. Either DAX, Eurostoxx, CAC, FTSE. Asia is mostly in the green except Nikkei, but it caught back overnight. And if we look at the US, it's green across the board, with a VIX that is stable around 13.5, but slightly higher than yesterday. And if we look at the US, how to say it, at the US index, I'm gonna put actually the other screen. This one is better to show what I want. Like we can see that yesterday there was a huge fall of the market. Like we can see that the Nasdaq lost something like 6,000 points. Now 6,000, like 100 and no, well, 300 points. Yeah, something like 300 points. And the S&P lost almost 100 points, 80 points, something like that. So we see that's basically like a big moves made by both market, and there was several explanation that was offered by either the media or everything. There was first the expiration of a VIX option that was basically propping up the market. Wesh, c'est quoi ce truc là? Ah yes. Ok, d'accord. So the VIX market, that was like the VIX option that when they expired propped up the market. And there was also another explanation that people were basically taking their profit from all the previous months rally, where that was quite continued rally, while so that was the two explanations I found this morning for this sudden move and change of heart of the market yesterday night. But I'm not that confident this is either of those are an explanation. I do like the people taking their profit. Seems to me the most, and by doing so, triggering waves of stops, and therefore of people that wanted to go long and then triggering each of their stop, which then caused them to sell the market, to close their position, then pushing the market down. That's basically my explanation of what happened yesterday. But I might be wrong. It's only my opinion. So that, if we look at Forex, where is it? It's on this screen. Yeah, it's here. I'll come back here. We can see that Euro GPY is still on the way down. So GPY is actually still getting stronger, on a strong momentum compared to the dollar, even though December is a season where dollar tend to mostly fall. It's the worst month for dollar, and January is the best one. So that could also be an explanation. We can see that the Euro USD is 110 level. If we look at several times, we can see that's been already like 3 times that we've been pushed back. But come on, I just have to say that so that he goes through just in front of us. That's it. Well, and basically we can see, if I'm going to show you here with the future chart on Finviz, when basically we can see that the dollar future is really going back down, when the euro is going up, the GPY is going up, the GBP, basically every money are going up except the dollar. There might be also, talking about commodities, so gold is still stable around 2050. Around 2050, slightly up, depend on the day. But at the moment, it's currently stable about that. The WTI was at 74.5 this morning, and now it's 73, so it's went down, but it still went quite up since last week, where it was around 70. Wheat, the US wheat, it's wheat, might have actually a market opportunity, where there's probably soon going to be some, like I said, opportunity to make money on the wheat. For example, potential double bottom here, with also and therefore a trend reversal there, like here. We also saw that earlier in May and June, there was a short squeeze on the wheat. Yeah, I think it's wheat, on the wheat. So there might be now other opportunity, and people shorting the wheat market may find some may need to close their position. So there might be some opportunity there over this, but like I say, it's not. It's what I'm saying is clearly not investment advice and should clearly not be considered as such. It's only my opinion, and as I said just Livermore, opinions are often wrong. Like markets are never wrong, but opinions often are. Therefore, I might be wrong, and it's only normal to see to be wrong. So blah blah blah. PC, on s'en fout. So now we are done with that. So now let's try to see the market. So basically, I've already put some support and resistance that are basically the same ones since that I drew like a long time ago. You could see that we had yesterday an all-time high, and that we corrected since from a pretty strong, quite strongly actually. But basically, the previous all-time high was somewhere there. So basically, what we could also argue that this created a new low, because this would be a low, this could be a new low. We could also it might be a sign that the trend is over. especially if we combine that with the analysis and the Elliott wave count, it could show that the market is gonna dip. So that's more or less actually my opinion for the day. I was I can show you my notes, but basically my main expectation was the market was gonna come up until here. So I did that this morning, so we were here. Yeah, at 11:45. So I wrote that here at 11:45. I said market's gonna come here and then it's gonna dip. So, but if we look at the Elliott wave, I found it a bit stretched, to be honest. And but like I said, as you can see, trade plan, my 2 trade plan for the day. So an entry at around the price where we are. Probably looking at the order book, I might have to take it higher. But the way the market's moving now is telling me that this is not the time to take this trade. So I might switch this trade plan. But basically the entry was 47.88 with the stop above my resistance. But since we broke it earlier, it would be a stop around here. And then a take profit somewhere there. That was my first trade plan. And my second is to grab him in the fall, because I wasn't sure that the market was not gonna fall before we reach this level. Oh, nice. Wesh, ils sont passés où les 400? So we saw the block disappear. We're gonna see how it goes afterward, but there might be a big buyer that we don't know about, but also it might just be a spoofer, so we're gonna see. Or I might have just moved them to lower levels. So yeah, and like I said, my second trade plan is I take him here, I catch him here, I put my stop somewhere here, and I still go all the way to here. That's basically my 2 trade plan of the day. And at the moment, yeah, I'm not gonna sell this market at the moment, because it's kind of crap. It's very rangy, and I do want it to break, to be honest. At least downward, and I might. Yeah, that's why I didn't took it. I wanted to take it lower. But I might sell him somewhere there. Well, you can't see, but I might sell him earlier. We're gonna see. So while we wait for the market to go catch our second trade opportunity and to be in the direction we want him to be, I would like to address a topic that's quite important in trading. It's the psychology. Very often, people think they have a great psychology, great like a mental strength. But in reality, you really can't know what's gonna happen when you're trading before you've traded. Like there's a countless example of very successful businessmen that when they were trading failed quite miserably. There's a countless example of people that thought they had a very strong mental strengths that in the end failed, and psychology is one of the main reasons why retail investors lose money. Mostly it's not due to a lack of knowledge or skills, but rather due to psychological factor. One of the biggest enemy you can have in trading is the ego. You can always say people that are always gonna like the ego is the one that prevents you from turning off your computer when you're having a bad day, saying no, I can't have a bad day, I can't have a losing day, stuff like that. That's mostly the ego, and that's one of your biggest enemy. And also that's the one who say, oh no, my position is not wrong, I shouldn't close it, or while especially it's your it's in general not it's always never the good idea to hold the wrong position. Like hope is not a strategy. That's quite a famous saying. So then another problem is the Dunning-Kruger effect and overconfidence. It's basically a psychological trap that is basically that show that when you have a low ability, you tend to overestimate your ability, and with more competence, your confidence will fall down, then goes up. And this manifests very obviously with young trader, like with beginner trader, taking way too much risk, thinking that they're the best trader in the world, that they can't lose, and in reality, they're gonna then discover that they're gonna get a very significant loss, because most of the time this is how to say it, combined with big ego, and that's to make them believe they can't be wrong, so they tend to hold their loss for a very long time, and hoping the market will come back, and most of the time it doesn't. Also, trading is a journey that is filled with up and down, and most of every trader, you can look at the biggest trader in the world, they've all had a period where they lost, and this is when you know a good trader than from a bad trader, because the good trader will survive this phase and continue trading, while a bad trader will either give up on trading, or continue or lose all his capital and be forced to stop trading. So that's why we tend this is how you can tell who's a good and from a bad trader, because a good trader will survive long enough to show that to be able to overcome this downtime. Also, one big part of trading psychology is emotion management. Because, for example, when you're trading, sometimes you see when people are seeing big money amount on the screen, they tend to fear the market and the possibility of loss, and therefore it might force you to sell too early, or not to invest at all, and at the opposite, it can force the fear of missing out, can force you to buy at peak, can make you buy when an opportunity is gone, and therefore it's peak price. So it's very important to be strong with your emotion, and the same way greed can be as damaging. The desire for more profit can lead trader to hold onto a position for too long, hoping to get an even higher price, and just to see the price drop and your profits diminish. Regrets works as well, and impatience is one of the biggest problems. Like, for example, with Elias, who's a former student who's now trading from the trading floor. He had, in the beginning and still now, he had a tendency to take his trade too early, and close his position with loss, just because he entered too early, and if he had waited before, if he had waited and let the market go to come back later, he would have had he would have been able to make to be in a winning trade from the beginning and not. But patience is important. Over-excitement works the same, because if you get too excited, you will start to overtrade and then you're gonna lose. So that's something to avoid as well. And to summarize, basically, you really need to have to be aware of your emotion and manage them efficiently. Otherwise, you're not gonna be successful. So that's one key point you really need to understand. So we can wait, like we're still waiting for the market, even though you can't really see it because the connection is so bad, like 99% packet loss. Well, on my screen, at least, the screen is like the market is fine. It's just that not for you. But anyway, so basically, a technical analysis is a method of studying the price and present behavior of the market to predict its future movement. But there's very useful in technique, but there's chart, indicators, pattern, trend, stuff like that, to analyze price of different security, and it can help investor and trader to identify trading opportunity and manage risk. For example, we're using trading like technical analysis to figure out our entry point, our exit point, and and our entry point and our exit point. And that's how we figure out like, okay, so I want to enter at this price, or at least in this price area. I want my exit to be at this price area, and I want to and we use technical analysis for that. So basically, what are the main concepts of technical analysis? So basically it's the trend. So it's about the general direction of market for a certain period of time. For example, like if we look at the 4 hour here, the part where I drew like the line were like upward trend. This here was a downward trend, and if we look on the overall from here, the market is in an upward trend from over there, from since and is that since October 2002 to 22, sorry. So okay, that's it for the 4 hour and the trends. Then support and resistance. So basically, all the lines you see on my screen are support and resistance. So what is the support and resistance? It's it's price level where the price tend to bounce and reverse. For example, the support is a price level where buyers tend to enter the market, like where buyers are gonna enter the market pushing the price back up, and resistance is the opposite. It's a price level where there's like lots of sellers entering the market and pushing the price down. There's lots of ways to mark support and resistance. So some people use Fibonacci, d'autres are gonna use pivot points, and some other tool. Then there's chart pattern, or in français figure chartiste, in French figure chartiste. So that's why you're gonna have like a double top, triangle, wedge, flag, pennant. Like there's a lot of them, but mostly if the most common one are gonna be a double top, double bottom, and maybe pennants, but they're not But chart pattern are only are not that are not 100% viable and should not be the only indicator you're using to enter a trade. T'as pris ton trade?
Ouais, j'ai pris, j'ai fermé.
À combien?
C'était un support des. Je sais pas, mais en tout cas, j'ai pris 1055.
C'est bien?
Ah, je crois que je vais faire que ça, je vais pas tester.
Bah vas-y, hein. Enfin, un fond tester, mais ok.
Bon, on se dit à demain.
À demain. T'avais pas mis de stop, si?
Hein?
T'avais pas mis de stop, si?
En fait, je l'ai pas mis en rentrant. Après, je l'ai mis au point d'entrée, genre.
Ouais, c'est pas ouf ça.
De toute façon, il est pas allé. Ouais, en temps normal, je l'aurais pas pris comme ça, mais il est pas allé. Enfin, j'ai pas été en perte.
Ok, ok.
Enfin, il est pas allé au-dessus de mon point d'entrée. C'était un short.
And basically the last point is going to be indicators that are mathematical calculation based on price, volume data, and it's going to provide additional information about market condition. And some command are going to be moving average, oscillator, Bollinger Band, etc., etc. There's going to be like a lot of them. So it's going to be too long for me to explain them all, but what I can say about indicators is that there's generally a reason why traders are only using a small list of indicators, because they have a proven track record, and that all the new 100% efficient new indicators are clearly not are not that valuable, and you should be quite cautious when using some random unknown indicator. Like no indicator is 100% viable, but some tend to be more viable, efficient than others. So technical analysis is not a perfect science. It's not really a science at all, but basically it has some limitation and challenges. Some of them can be related to market efficiency, because basically it's the assumption that all of our information is reflected in the current market price. Therefore, technical analysis cannot reveal any new information that was not already known. So that's an involvement of market efficiency. There are psychological factors where people tend to behave in a not so reasonable way, and sometimes are gonna affect the market. And where are we? We're here. And also time decay, because if you and lag, basically indicators tend to be laggy, and sometimes if you hold the position for too long, the effectiveness, the technical analysis factors tend to be too late before actual price movement, to lag behind actual price movement, because market is too either not liquid enough, or not there's not enough volume. Then let's talk about risk management. So basically risk management is one of the key tools that allow that separate retail traders to institutional one. Basically, risk management is the process of identifying, measuring, and controlling the potential loss that may arise from trading activities. And when you're a retail trader, you're going to face various type of risks: market risk, liquidity risk, credit risk, operational risk, and regulatory risk. Some of the common strategy to manage risk for retail trader are going to be like actually quite easy one, but still pretty effective if you follow them efficiently. So the first one is going to be like the most important one is going to be the use of stop loss order. They're going to be orders that are going to close automatically any position you may open that you have opened, and that's going to allow you to limit the loss you can take. I always say the same sentence, but when I was in school, one of my teachers said the people that trade without stop loss, we sit in front of them and we watch them cry. This is like the truest sentence I think I've ever heard. Why was this trash before? Yeah, sorry, I moved some resistance and now I'm a bit lost. Well. Then there's the concept, like the obligation to write your trade plan, because it's gonna allow you to keep you it's gonna allow you to trade with a clear direction or purpose, to not to prevent you from trading from impulsion or prevent you from trading from impulsion or impulse rather than logic, force you to do your research before trading. Like it's only gonna be beneficial for you to trade with a trade plan. It's gonna also like force you to say, okay, so this is my stop loss, this is my target, and it's gonna then also help you to calculate risk reward and stuff like that. Depending on your level of your preference, you can add more information, but it should always be written in detail and explain why you want to take this trade, at which price, and until which price. And also then there's going to be another tool you're going to have is going to be like calculate risk reward and position sizing, even in a way that even though your trade is going the opposite way compared to what you've planned, you're not going to burn through all your capital. So what were my default for today? Why wasn't I able to enter my trade today? Because I was unrealistically greedy. I saw what happened yesterday, found a list of reasons of why it should happen today, even though there's no objective reason why. And therefore I wanted to have the same type of trade, same type of movement, even though I know that movement this side take time to develop and happen. So the probability that it would happen in the 1 hour time frame that is the live was highly optimistic, to say the least. And especially now, especially like on the S&P, if we look a bit more, we can see that we have a climbing market, at least for now. So this is not a market you should consider selling at the moment, at least. Even though I still believe in what I wrote, just not necessarily at the current moment. Probably, yeah, probably not today. Hopefully tomorrow. So like that, I don't have to rewrite my scenario, and I can. Yeah, because it was probable that the market was gonna range a bit today and try to take its profit from yesterday. So that was nice of you all of being here, even though there's no one. So for everyone watching in replay, don't hesitate to like, follow, subscribe, hit the bell, do everything so that you can be there live and ask me the question you want to know. And well, see you next week in English, and